Welcome to the Daily Update. This is being prepared Monday, April 25th, where we'll look at the action in the market today and then see how things look for Tuesday, April 26th. And before I get started, there'll probably be some background noise. Somewhere around where I'm recording is some construction taking place, and I can't really control that. I don't know if it's going to start or stop. Hopefully, I can make some of this noise go away when I try to work with the audio a little bit, which is another thing I'm trying to do. I know the audio quality has been very different over the last few videos. I'm really trying to improve that, but I kind of have to experiment it, and I could spend all day doing this and still not be happy. The main thing is to record the video, get it somewhat presentable, and then upload it as quick as possible so people have an opportunity to watch it as soon as possible for those that find it useful. So let's go back over Monday and see what happened. It ended up being a bit of a bounce, kind of what we were looking for after Friday. Our short-term indicators had been oversold. Some of our intermediate term indicators were also looking a little bit oversold. So to end up closing with an up day was not necessarily a surprise, but it hasn't done a lot to improve things. The big question now is, can it continue? Are we going to see any kind of a follow through right now? But we did have a gap lower right at the open. Things started out, at least at the beginning, it looked like, okay, we had Thursday and then a Friday, and it looked like we were just going to pick up right again with Monday and just start going lower. And for a lot of the day, that's what happened. Well, we eventually found some support and were able to bounce up off of that. So we did have the gap lower open, and we quickly went down below S1, which was at about 42.31. We kind of bounced around that level as the day went on, kind of a little bit above, a little bit below S1. And then later on, and this is why I pay attention more to the latter part of the trading day, because this is when the professionals come in and do what they're going to do. At least that's how I view things. And they took prices back positive. We did see some late day buying. We closed almost at the high, just a little bit off of the high, but below the daily pivot. So yeah, this was just kind of at this point, could be classified as a dead cat bounce, where it hasn't really changed anything. We had gone down pretty far, pretty fast over the last few days. We were going down fast on Monday. Some of the more aggressive traders decided to step in, and that pushed prices back higher. We ended up closing up 0.57%. Not a barn burner of a day, but still an up day nonetheless. The one thing that is interesting is we, for the first time in a long time, without a big move, saw above average volume. The technicals are still pretty much negative across the board. Most market participants are still really fixated on inflation and interest rates. Of course, we have lots of geopolitical concerns, things coming out of Russia, Ukraine, things coming out of China with the lockdowns, and how can that feed over into the supply chain issues in the U.S. Earnings are coming out, which can either help the market or hurt the market. And then, of course, the big news on Monday was Elon Musk's successful, apparently to this point, takeover of Twitter. What are some comments? I was watching things during the off hours, and China and Asia, and yeah, I know China is in Asia, okay? But China's kind of its own thing when it comes to the stock market. Asia is usually Japan, Hong Kong, Singapore, places like that. That's what I'm talking about with Asia, because big things can happen in China, but they don't really impact the U.S. market. On Monday, anyway, both China and Asia were pretty strongly negative. Also, Europe was pretty strongly negative. Macron was reelected in France. A lot of the other things going on there right now just gave a more negative tone to things, and that fed over into at least the open of the U.S. session and just kind of fed into the negativity that's been happening. There was a slight recovery that we saw from this short-term oversold condition that we've been talking about. Oil did drop back below 100. The technicals, yes, they're still negative overall, and I'll prove that as I go through the charts. The S&P is still in correction territory. Even with the slight recovery on Monday, we're still down over 10% the way I calculate them, going back to the all-time high. And then, of course, the big news about Twitter and Musk. There were no economic reports that were released on Monday. Our trend, it is developing into a new trend, and that's probably going to be a negative trend unless things really switch. Overall, we're still looking at a negative trend. The bias, because we had the slight up day, I switched back to mixed, but it's really still more negative. And our momentum is still negative. We need more than just a 0.5% gain to really turn things back around to look more positive. So let's go through the day's session. Here's the CNN Fear and Greed Index. I'm trying to get used to how this looks. I really like the old one better. We're right at 40, which was no change from Friday. And I'm getting a little suspect with some of their numbers, but nonetheless, it's a free tool that we can use. And we're in fear territory, but more in the midpoint of things. And here's the longer term chart. We need to see this drop an awful lot more to show some kind of critical mass fear. And we're fearful, and people are kind of down on the markets, but we're not at an extreme point, at least right now. Here's the VIX. And again, I've tried to go through the charts and label them. Hopefully they're big enough. If you have any other feedback that you want to give as far as, do I make the letters bigger? Are they fine? Should I change the colors? Should I add more information? Please let me know what you think about that. But with the up day, we ended up seeing a down close on the VIX. Now, the VIX had really spiked up as we were going lower, and we closed well off of that high. Here's another chart that's kind of new where I have the VIX up above, and then this is a 9-period RSI, which is plotted with that. We came right up to just below the 70 level and then have come back down. So that just means that we could be getting, or we were close at an extreme reading. We could turn and go back up from here. But this is a little bit of the short-term oversold condition that I was talking about. We'd like to see this go a little bit higher to be even more extreme, but just the fact that it was close and then turned is kind of what we have to go with for right now. Then here's the VIX of the VIX. On a closing basis, it did decline, and it also spiked up during the day, but then came down off of the highs. And the VIX is moving pretty big right now, so that's why we're seeing a pretty big bar on the VIX of the VIX, at least over the last few days. Here's the Ulcer Index, and as the markets are going down, this indicator goes up. Well, with the up day, we ended up going lower on the Ulcer Index. Then this is a new chart that I showed for Monday's video where we saw a real spike up in the put-call ratio. Well, that really came down in Monday's session. So the thing to talk about here is, was this a spike and we bounced a little bit? Are we going to go a little bit lower with this, which means prices could go higher? That's what we're trying to figure out right now. Then finally, and I like to do this in the weekly videos, but when I'm recording that, the charts at currentmarketvaluation.com are just not updated yet. So, and I want to do the recording and get things posted. So it's kind of, I've had to default to doing it after Monday's session for the Tuesday video. And this is just another screenshot of what they come to overall, where they're saying that we are fairly valued right now. Not a lot of changes. The yield curve is still fairly valued, but still they calculate things different. They go from the 10-year to the 3-month, which never did go inverted and in fact has been widening. The Buffett indicator is still overvalued, but not as extreme as it had been. The PE ratio, same thing. It's still overvalued, but not as extreme. Interest rates, because they're still so historically low, that's giving us more of a fair value look at things. Margin debt has not been updated since the end of February. The mean reversion, we are overvalued. We had gotten far away from the mean price into this red area. Well, we're coming back down slightly. So Yeah, if you take this in the whole, it might be fairly valued. If you're looking at it more on a stock market basis, you still might conclude that the market is overvalued. As far as our sector, since we had an up day, I sorted it according to tech having the best day, being up 1.5%, communication, and discretionary. These are the three areas that have been hitting hard a lot lately. Some of the areas that saw weakness were areas that had been showing some strength. Real estate, utilities, and energy was down pretty significant, down 3.31%. Here's a chart going back to the all-time highs where energy is still doing quite well. Not as good as it was, but still doing well. Utilities and then staples. Way over on this end, the areas that bounced on Monday, communication, tech, and discretionary, they still have a lot of work to do to really improve. Then here's just the tech sector in isolation, where we saw a 1.5% increase or upward move on Monday, but still it's not a real healthy looking chart at this point. Here's the semiconductors. They were down up 1.69%. They got back up to the lower end of this very short-term sideways move that we've been seeing lately. As far as inflation, and I added some things, this just breaks down what is the CRB index. I've had a few questions about that. Well, you say it includes inflation. Well, what does that mean? Well, 39% of the CRB is energy. So yeah, energy's been going up, and this is almost 40% of the overall index. So if oil and a lot of the energy sector stocks go up, we're going to see the CRB go up. Agriculture, that's the things, of course, that we use for food. That's 41%, precious metals 7%, and industrial metals. These are a lot of the things that are used to make things that we have to buy in order to live. It was down almost 2% on Monday, but still is in an overall pretty solid uptrend. Then this is just looking at the CRB against the S&P 500 and a ratio where the CRB, at least we can get into about 2021. So for the last year and a half, the CRB has really been outperforming the S&P 500. This is an inverse look at that chart, how the S&P had been really outperforming commodities. Well, lately it continues to underperform. Now, I'm going to start including more Fed Watch charts because we're getting closer and closer to the meeting. I said I was going to do that in the weekly update, and then I got caught doing some other things and I got distracted and I started recording and went, I forgot to include some of those charts. Well, I'm going to include them now. So we're more on Fed Watch now that we're getting closer, but not a lot has changed. And there's nothing really that's a surprise. At the next meeting, there's a 97.6% chance that after that meeting, the Fed funds rate will be at 0.75% to 1%. That's actually dropped a little bit. It got up to like 99.6, or I mean, just almost absolute. And this will fluctuate daily depending on what happens each day. And here's just the historical chart. The purple line, I said pink line in one of the videos, but this is purple. I do know my colors, where we hadn't even really been considering this at the beginning of March. Well, all the way through March and into April, now that is the going consensus. And now we're looking out to the June meeting, where they expect an 89.3% probability that after that meeting, they're going to raise interest rates another 0.5%, and we will be at 1.5 to 1.75 as far as the Fed funds rate range. And here's just a historical chart to look at that as well. And then looking out into July, at the July 27th meeting, right now there's an 88% chance that after that meeting we'll be at 2 to 2.25% for the Fed funds rate. So we're climbing 2% in 7 months, according to this, which there's the big debate going back and forth. What's this going to do to the economy? Is this going to really help inflation? And we'll kind of play that out on a day-by-day basis. And then here's the historical chart of that as well. And I know this looks all weird and crazy, but sometimes getting a little bit of a perspective can help with these things. We had a lot of technical alerts, and because we were down at the open and these right from the bottom up, we saw an awful lot of negative signals. Then we saw a few as things attempted a recovery bounce later in the day. I'll just pick out, let's see, the S&P had a BPI cross below 50, and I have a chart that shows you that. Finally, the NASDAQ got back above 12.9 and then 13,000. Oil was below 100. You could see that as positive. Gold was below 1,900. And then the dollar. It seems like every day now we're seeing new 2-year high, new 2-year high, new 2-year high. This is the second or third day in a row that we're seeing this. Intraday. Okay, so here's the Thursday, Friday move, which was pretty scary. And it's what a lot of people were talking about over the weekend. It looked like, oh boy, here we go. I was actually looking at more of a pop earlier because of this gap down. I thought maybe down around this level, buying might come back in and really be able to take us higher. That didn't happen. I was watching for it. And again, I'm always playing scenarios out. I might be saying, okay, what's going to take the markets higher? What's going to take them lower? What's going to keep them the same? And then sometimes those are wrong. And so then I just adjust them. And then when I finally come to a conclusion that I feel pretty confident about, then that's when I make a decision, whether to get in or get out, what kind of position, what kind of strategy, and so forth. Well, we kind of treaded sideways above and below S1. Well, then as the day went on, we were able to get prices back up. And then we danced a little bit along the unchanged level, which now was acting as resistance. Bounced back down from that. We're able to break through as we were getting into the close. And this is where we closed it just off the high. But you see this dark blue line here, that's the daily pivot. If we're above that, that's positive. If we're below that, that's negative. Well, we never got above it. So yeah, we had an up day and this is pretty good, but I'm not trying to read a lot of real positivity into this, at least yet. We've got to see some follow through here. Here's how it looks on the daily chart where we were able to get back above this intermediate term support. This was long-term support going way back to last fall. Well, the fact that we could close above that is pretty positive currently. And then down here, you can see where volume was pretty strong compared to what it has been. We're down 10.43% right now, so we're still in correction territory. We're still far away from the 200-day simple moving average, but we turned up a little bit with the slight advance on Monday. Growth and value. Growth saw a little bounce. Value saw a little bit of a pushback. Here's the growth index against the value index ratio. And this just shows how growth has been underperforming, even though it had a little bit of a bounce on Monday. This is an inverse showing how value has been outperforming, even though it had a little bit of a decline on Monday. Here's the NASDAQ 100 against the S&P. A lot of the companies that have really been hammered lately are NASDAQ 100 companies, so it had a pretty good up day. Here's the pure growth index, where it was up over 1%. Here's the value index, which was down 1/3%. And then here's a ratio between the two, where overall growth has been really underperforming. And then here's an ETF also showing how growth has been underperforming. And then this is showing you how value has been doing better lately than growth. And that's the overall trend. As far as our trend, yes, we are turning back up. The line has crossed the moving average. So if you're a little more aggressive with the ADX, you might say, okay, we're in a trend now, and I'm going to do a trend-based strategy. The red line's on top. Okay, so I'm going to go short. I'm going to go into inverse mutual funds or inverse ETFs, or I'm going to do some short positions or some puts or some strategies that benefit if the market goes down. You might be willing to do that. Others that are less aggressive, a little more conservative, you might want to wait until this actually goes above 20. Then our rune didn't really change from Friday. It still shows that sellers are in control. The reason why our oscillator declined a little bit is we saw a little bit of tapering off with the buying power. No change on the decision point scorecard. Breadth, and I have another new chart and I have new labels here. Here's price, where it did pretty good on Monday, and volume pretty good. So we saw a little bit of an upturn with the advanced decline line based on price and a little bit of an upturn based on volume. And the advanced decline ratio saw a little bit of a bounce, but we're still below zero. Here's new highs, new lows, continue to trend lower overall. And then this is one of the newer charts. This is just a straight advanced decline ratio. This just takes the new highs, the new lows, and just shows us, well, the reason I'm bringing this up is after Friday's session, we were pretty extreme negative. So to see us bounce up from that is not necessarily surprising. Then here, the accumulation distribution turned up a little bit, but we're still below a declining moving average. Short term, well below the 20. Our moving average steady, little tick up in the 20, still a bit of a decline in the 50 and in the 100. And that should actually be a 200. That's a typo right there. Sorry, change that 1 to a 2. Our moving average spaghetti tree, we're far away from that right now. The MACD continues to decline. The Swinland trading oscillator declined a little bit based on price and a little bit more of a decline based on volume. McClellan oscillator, it bounced up, but is still below zero. Williams per, I always want to do that one first. Stoke RSI, pegged negative, but bouncing a little. Williams percent R, pegged negative and coming out. And so this is an official oversold signal that's being generated by this indicator. The force index, and since this is really hard to read, I'm trying to highlight where the close is for this particular indicator. And we bounced a little bit, but we're still negative. And then I bring this up because after Friday's session, we were showing an extreme reading, just rate of change one day from Thursday to Friday. And we had moved down so aggressively that pegged this near the bottom. Well, with a bit of an advance on Monday, that shot this back up into more of a neutral territory. And I'll take this chart off after today because I just wanted to show how this reacted to that. Intermediate term, well below the 50s, well below the 100. Our PMO continues to decline pretty much across the board. Our PMO studies saw a little bit of a bounce with those PMOs that are rising, and this is coming out of an extreme negative reading. We're still seeing a decline in the percent of buy signals, and those PMOs that are above zero continues to decline. So shorter term, we worked off a bit of the oversold condition. Intermediate term is still continuing to look weaker. Bullish percent index with the down open and the negative territory that we were in for the early part of the day, it generated a lot of new point and figure sell signals. And this is one of the technical alerts where we dropped below 50. So this is more negative now. And here's the longer term chart of the BPI. Our moving average rainbow, we're just, no matter what color, no matter what period we use to calculate these, we're far, far away. Here's the intermediate term rainbow and then the long term rainbow. Stochastics bouncing up after giving us a short term oversold reading, still looking extreme with the intermediate term, long term still declining. Summation index, because the McClellan oscillator was negative, we continued to drop based on price as well as volume. All of our momentum oscillators are still negative. They really didn't change after the little bit of a bounce. The CCI on 14 periods, it's still giving us an extreme negative reading. 20 periods also really hasn't started to turn up on either one of these yet. Chicken money flow saw a little bit of a bounce, but is still negative. Vortex saw an increase in selling and a decrease in buying, so it's continuing to look more negative. The RSI study turned up a little bit on both of these, but we're well below 50. The 9 period had gotten down just about to an extreme negative reading. Balance of power continues to decline overall. The Connors RSI bounced a little bit after giving us an extreme reading after Friday. The Fibonacci retracement, we were able to get back above the 50% as far as the S&P is concerned, and we're still below the cloud with the Ichimoku cloud. Bollinger Band, and again, I'll probably take this off now. I just wanted to show how we went extreme negative and bounced off of that. We had come outside of the Bollinger Band, and that gives us the extreme reading. Well, now we're back inside the Bollinger Band. As far as our trading systems, Elder Impulse for the S&P is still negative, as well as for the SPY. And the SAR continues to be negative. Different charts, Heiken Ashi still looking negative. Kegi looking negative with the red. Renko has not changed. It's like this chart just won't do anything. It's because it's seeing these prices where we've been before. And so it's not picking up anything currently. 3-line break is looking negative. Equi-volume, we're just going to have to bounce up. We saw a little bit of a bounce with the ease of movement based on just 1 period, but we're still declining based on 14 periods. Point and figure, no change in the signal. It's still a high pull warning. That's the X right here in the middle, but it did add another 0 when we went lower earlier in the session. Long term, we are below the 200-day moving average. And then our mega stocks, they were up 1.25%, but still in a pretty significant downtrend overall. Special K continues to decline. Longer term moving averages saw a bit of a decline in the 50, a little bit of an advance in both the 150 and the 200. Broad market, here's the S&P. Here is the mid caps. And here is the small caps. I like to just look at these visually sometimes without any indicators on them. And I like to look at them in a stack like this just to get some perspective of things. Here's the Dow Jones Composite average where it was up 0.57%, but still we're seeing price and these moving averages really close to each other, which is showing overall indecisiveness. Here's Dow theory, a little bit of a bounce in the Dow, trannies, and a decline in the utilities. The FANG stocks, and yes, it should be FAA. One is Apple, the other one is Amazon. Where the G should be Alphabet. It should be FAN stocks, but hey, FANG sounds cool. We were up less than 1%, but there was a bounce. You could say maybe there's some kind of a double bottom being put in here. The ARC Innovation, also looking at a potential double bottom, was up 3.6%. Here's the Dow. Even though it bounced, we're still below the pivot, still below the moving averages. The diamonds are still negative. Mid caps saw a little bit of a bounce. Have a ways to go before we get to the pivot and below moving averages. Okay, the NASDAQ, it bounced back above, got above this pivot level, but still is below both moving averages. NASDAQ 100 came back above the pivot. And here's the Vixen. This just shows, this is the VIX of the NASDAQ 100, where it had really spiked up but closed almost near the low. And on a closing basis, it actually declined. The Qs are back to neutral right now. NYSE Composite, this is kind of interesting. It opened and then went down and kind of closed right about where it opened. It ended up just changing 0.01%. Now, that could be seen as somewhat positive. You've got a broad-based index. Even though we were at an up day, this held up. Or you could also see this as negative. We had an up day and this didn't really move. And the S&P 100 outperformed the S&P 500. The Wilshire, it had a bit more of a bounce. It was up 0.2%, but a little bit more damage has been done to this than the NYSE composite. Internationally, China just getting hammered, as well as other Asian stocks, European stocks, US stocks. Everything is pretty much down right now. Here's our all stocks, which advanced just a little bit. There's a slight uptick right there. Broad market, the dollar just continues to hang in there, up another 0.55%. Here's the weekly chart thus far. Oil dropped down below 100 to 98.54. Gold was down almost 2% in the futures contract, down 1.8% in the ETF. And here's the longer term view. Silver also down over 2%. I like this should be a joke. Silver just got hammered. All right. Yes. Okay. Maxwell silver hammer as we decline here. And here's the long-term view. Bitcoin's kind of flittered around the upper 39s. When I checked a little while ago, it actually got up into the 40s again. But it's been bouncing a lot too, but not really going anywhere. Bonds, here's our yield chart where we only have one chart currently. The 10 to the 5 is the only inverted yield curve right now. And that's this chart right here. We're inverted by 0.03. And here's the Fibonacci of the 30-year yield, which we broke above the 61.8, got just about up to 3% and have been falling back slightly. Yields, we're seeing a real bunching up with the longer term maturities, but shorter term, we saw an advance. And internationally, saw pretty much a decline, even though interest rates have been really going up. On Monday, we saw most interest rates decline. Bonds saw a little bit of a bounce, but you're hardly able to see it right here. And corporate bonds also bounced a little bit. The current yield is around 3.96%. Junk bonds bounced up 0.2%, with the current yield around 6.52%. Then here's the junk bond to bond ratio, where it actually declined a little bit because we saw a bit of a bounce in bonds. Relative studies, gold is still looking like it could be breaking out against the S&P. Energy against the SPY shows a much more solid breakout, even though it declined on Monday. Here's energy and tech, just showing how energy's been really going up as tech has been really suffering. Here's growth against the 20-year bond, which growth has been having trouble, bonds have been having trouble, so we're not really seeing this move all that much. The tech has really been underperforming the rest of the S&P. Here's tech against the 10-year yield. It just shows how tech has been underperforming. This shows how the 10-year has been outperforming tech. And then this correlation seems to be kind of going away now. We saw a little bit of an increase in, okay, this is going to be weird to say, an increase in the decrease of the inverse relationship. I don't know if that makes any sense. But we still want to watch this just to see how things are. But just because interest rates are going up does not necessarily mean that tech is going down and vice versa. We're losing that relationship right now. Now, it could always come back, but right now it does appear to be lessening. Discretionary actually bounced a little bit when compared to staples. Staples declined. This is a new chart. Staples declined a little bit compared to discretionary. Here's the S&P, how it's underperformed. Interest rates rising. Low volatile stocks were down slightly, but they still continue to outperform the S&P overall. And then we're just watching this. We're watching to see if we get a bounce out of small caps, and then right after that, can we get a bounce out of the S&P? We're not really seeing much right now. It was up a little bit, but we want to see a little bit more healthy bounce, at least in the relationship between the two. And then that might be a signal that we can look at, but we're not really generating one right now, nor are we sure. See, we spiked up a little bit more here. We don't really know about staples. Has staples spiked at this point? We don't know. So what's our outlook then for Tuesday? Technicals are negative. Can the short-term bounce continue? Can we continue to work off some of this short-term oversold condition? The markets are still trendless in an intermediate-term range. The battle between growth and value continues. The supply chain issues, mainly because what's happening in China and then all of the ships sitting offshore and things like that. We do have a pretty big slate of economic reports coming out. Consumer confidence, new home sales, durable goods, housing price index, the Case-Shiller home price index. So a few real estate more indexes. Consumer confidence, durable goods, and new home sales. That's probably the ones that would have most of the impact on things. And then all of our continuation of the geopolitical events. So here's our scenarios. If you're more conservative with the ADX, you are in number 3, sideways scenario. The ADX is still below 20. It's starting to climb and showing a negative trend. When that happens, we see price really slow down and become choppy. All right. If you're a little more aggressive with the ADX, it is defaulting to a negative trend. So watch interest rates. And if any of the economic reports come out showing inflation fears, that could spook the markets. An earnings report coming out could spook things. Some kind of Fed speak could be taken as negative. And our technicals are pretty much negative across the board. What could make the market go up from here? Short and some intermediate term oversold. We could still get a bit of a bounce from that. And then something, I don't have any charts to back this up, and I don't want to have them until I actually have something to show you. But there are some longer term bottom signal indicators that we're looking at that could be setting up to generate some signals. But it's too early right now. These have been sometimes reliable. Sometimes they work, sometimes they don't. They worked really well in the middle of March. But I'm starting to see this. But it's going to need some time for these to work out. So that could be part of the scenario. I just wanted to mention that here. But there's really not much to look at right now. The positive backdrop after the yield curves invert, that's off the table, because the 10 to the 5 is still inverted. And then the staples, we don't know if they've spiked extreme yet. Then our technicals, some of the moving averages, some of the pivot points may provide support or resistance. So that's kind of the positive scenario. And you kind of have to dig to look for things that are positive, which that in and of itself can be an indication, because when everything shifts over to negative, that's sometimes when we've hit an extreme. But we're not extreme negative right now with a lot of our readings. So what's our conclusion? The S&P is negative, short-term negative, but could be bouncing. Well, it did bounce on Monday. I'm really asking, can it continue on Tuesday? We are negative intermediate term. Our oscillators are negative. We're below all of the moving averages. Long term, we also continue to be negative because we're below the 200-day simple moving average. Here's just a list of the different videos that are available to you. So thank you. Have a really good Tuesday, and I'll prepare the next report after Tuesday's session.